Welcome, learners. In today's session, we are going to explore the fundamental financial tools used in cost and management accounting. By the end of this session, you will clearly understand how costs are identified, classified, measured, budgeted, and controlled in a production environment. We will unpack key concepts such as cost elements, cost behavior, costing methods, budgeting, variance analysis, and working capital. This session is designed to equip you with practical knowledge to manage financial resources effectively, reduce waste, support accurate planning, and strengthen decision-making. These concepts will not only guide your responsibilities as a supervisor in the workplace, but will also prepare you for your formative, summative, and ISO assessments. We begin the session by understanding what cost and management accounting means in a supervisory environment. Let's begin. Now, before we head into cost components and cost classification, let's take a moment to understand cost and management accounting. Cost and management accounting provides the financial tools that supervisors need to manage resources effectively. It enables clear understanding of where money is spent, how costs behave, and how financial data influences decisions. Without these fundamentals, it becomes difficult to manage budgets, control processes, or manage performance accurately. The first major area in KTO1 is understanding the components and classifications of cost. Let's begin by elements of cost. Every production system uses three main elements. 1. Direct materials. These are raw materials that can be clearly traced to the finished product. Examples include steel in automotive part, fabric in clothing, or chemicals in detergent. Direct materials form the physical substance of the product, and changes in material choice or quality directly influencing cost and performance. 2. Direct labor. This refers to the labor that is physically involved in converting raw materials into the final product. Examples include machine operators, assemblers, welders, and packers. Direct labor cost includes wages, overtime, and allowances related to these production roles. 3. Manufacturing overheads, which is indirect costs. These cannot be traced to a single product, but are essential for production. Examples include factory rent, utilities, supervisor salaries, cleaning services, and maintenance. Overheads must be allocated carefully because inaccurate allocation can distort production cost. Understanding these elements help identify where money is spent and how each part contributes to the total cost of production. Now we are taking a look at direct versus indirect costs. Direct costs connect clearly to a specific production or job, such as direct materials or direct labor. Indirect costs support multiple products or departments at once and require allocation. Examples of indirect costs include 1. Factory security, 2. Equipment depreciation, 3. Shared tools, 4. Supervisor salaries, and 5. Utility bills. Correctly distinguishing between direct and indirect cost is critical because it affects how costs are calculated and how decisions are made regarding pricing, production levels, and resource allocation. After separating direct and indirect costs, the next step is understanding cost behavior. Understanding how costs behave helps supervisors predict how costs change and production changes. Let's begin by fixed costs. Fixed costs remain constant regardless of production volume. Examples include factory rent, insurance, salaries of administration staff. 2. Variable costs. Variable costs are the increase or decrease in direct proportion to production volume. Examples include raw materials, direct labor in some operations, and packaging. And 3, semi-variable, which is mixed costs, which contain both fixed and variable components. Examples include electricity, telephone bills, and certain maintenance costs. Recognizing cost behavior helps planning, budgeting, and break-even analysis and forecasting. Costs may be grouped according to their function within the organization. For example, 1, production costs, which are associated directly with manufacturing. 2, administration costs, which forms part of managing the organization. And 3, selling and distribution costs, which includes delivering goods to customers. With cost elements and classifications covered, the next section explores costing methods. Before we head into costing methods, let's take a look at activity 1. Learners are to identify one example of each of the following. 1, direct cost. 2, indirect cost. 3, fixed cost. And 4, variable cost from their workplace. Let's begin. Now that we've completed activity 1, we see that costing methods determine how costs are assigned to products or services. Let's take a look at job costing. Job costing is used when products are made in distinct batches or customized units. Each job has its own material, labor, and overhead costs. Common in industries like printing, furniture making, or specialized manufacturing. Now let's take a look at process costing. Process costing is used in continuous production environments where identical units move through stages. Total cost is divided by the number of units produced. Examples include chemicals, food processing, and oil refinery. Now let's take a look at activity-based costing, which is ABC. ABC allocates overheads based on activities that consume resources. It provides more accurate costing when overheads are high or processes are complex. After understanding costing methods, the next major area is budgeting. Let's begin. A budget is a financial plan that estimates income and expenses over a period. Supervisors use budgets to manage resources, plan production, and control costs. Now let's take a look at purpose of budgets. Budgets helps to 1, plan future activities. 2, coordinate departmental functions. 3, allocate resources efficiently. 4, control costs. 5, evaluate performance. And 6, identify variances. Now let's take a look at types of budgets. Now that we're taking a look at types of budgets, 1, operational budget, which covers day-to-day operations such as labor, overheads, and materials. 2, cash budget, which predicts inflows and outflows of cash to prevent liquidity issues. 3, capital budget, which is used for long-term investments such as new machinery or expansions. After planning comes monitoring, which requires understanding variances. Variance analysis compares to actual results against budgeted figures. And now we are going to look at types of variances. 1, favorable variance known as F, when actual performance is better than planned. Examples include actual costs are lower than budgeted. 2, unfavorable variance, which is known as U, when actual performance is worse than planned. Examples include material usage higher than expected. Next, we are going to look at causes of variances. Causes of variances include 1, insufficient use of materials. 2, machine breakdowns. 3, incorrect budgeting. And 4, unexpected price increases. And 5, poor supervision or planning. Variance analysis allows supervisors to identify problems early and to take corrective action. The last major financial area in KTO1 is working capital. Let's take a look. Working capital consists of current assets and current liabilities required for daily operations. Let's take a look at components of working capital. 1, inventory, which consists of raw materials and finished goods. 2, debtors, which is known as accounts receivable, which is customers who owe payments. 3. Cash. 4. Creditors, which is accounts payable, suppliers that must be paid. And now we are going to take a look at the importance of working capital. Working capital ensures smooth production flow, prevents stockouts, ensures supply payments are timely, and supports daily operational activities. Poor working capital management leads to delays, penalties, and financial strain. Let's take a look at our short activity up next. In this activity, learners are to identify one working capital challenge that they have experienced in their workplace and propose one improvement. Let's begin. And now that we're done with activity 2, let's take a look at financial monitoring and supervisory responsibilities. Supervisors play a vital role in financial monitoring by 1. Checking material usage, 2. Reducing waste, 3. Monitoring overtime, 4. Reporting variances, and 5. Ensuring budgets are followed, 6. Keeping accurate records, and 7. Escalating financial concerns. This session provides the essential tools for financial decision-making at supervisory level. Understanding cost behavior, costing methods, budgeting, variance analysis, and working capital prepare supervisors for both operational planning and ICE assessments. Learners now have the foundation to support cost control, improve efficiency, and contribute to financial performance. Mastering these financial fundamentals enables you to work smarter, reduce errors, improve efficiency, and contribute meaningful to cost control in your workplace. Thank you, learners, for your participation and attention today. I will see you at the next session. Goodbye.